Welcome to Frankly Speaking with Sendra D, where we journey beyond the surface to uncover the essence of living an authentic, affluent life. I'm Sendra D, your companion guide on this path of self-discovery and empowerment. Welcome to another episode of Frankly Speaking with Sendra D. My name is Sendra D, and it is, of course, always an honor to be with you. But today I have a fantastic guest for you, and I hope that you will be as engaged as I will be in this conversation, listening to Mr. Richard Mason. Richard and I have known each other for more than 20 years, and we met through business. Him and I share a passion for real estate and real estate financing. Since we met 20-something years ago, he's gotten involved in many things, such as originating private money and also mortgage note investing. So those are the two topics that I'm going to bring to you today. And I hope that if you have any questions, just put them at the bottom of the video. Let me know if you want to hear more on the topic or not. But let me give you a little bit more background on Richard. And he is a board member of Vanguard College in Costa Mesa, California, program leader and participant at Landmark Education for 10 years. Student of success principles, motivation, sales, personal effectiveness, leadership training, and participates in many Christian ministries. And of course, this channel is all about leadership, so we have the right individual for this platform. And also, most notably, he participates in the Barnabas Group and the Family Research Council and Pacific Justice Institute.
Yes.
Richard, welcome. How are you?
Sandra? It's great to be here.
Great to have you. Did I miss anything? Is anything you want to mention so the audience can get to know you fully?
No, that's a great introduction. I appreciate it. I've been married for over 20 years as well, and we have a son who we homeschooled who's currently in college. So yeah, life's good here in Orange County, California.
That's fantastic. Orange County. I lived in LA, but not in Orange County. So on that, another area that we share, and I'm just going to bring that to the forefront of this conversation, is that I have been very transparent with my audience about my recovery process. And I just celebrated 25 years in recovery. I went through the AA program. I'm not necessarily so disciplined in that area as far as I don't drink, but meetings are not necessarily always on my schedule, but I do abide by the rules, which is primarily do not drink. How about you, Richard? I know you also have some experience with that.
I do. So yeah, in my teens and 20s, I definitely had a problem with drinking too much alcohol. And the short story is God swept into my life at one point and relieved me of that. And I haven't done anything like that in over 20 years as well. And I'm very grateful for that.
That's fantastic. Well, congratulations on it. It is definitely a rigorous path. And for those of us who choose it, it definitely is not for the faint of heart. So I celebrate you and I celebrate myself and all those who have gone before us to help us get to where we are. Let's jump right into the topic on hand, which is business. So first of all, I know your company is North Star Mortgage, correct?
Northern Star Mortgage Fund.
Northern Star Mortgage. Sorry about that. Yeah. Northern Star Mortgage. And you are a fund manager. Is that you're in that capacity? So what is primarily your strategy for your mortgage fund?
So we have a couple different outlets. So we do discounted mortgage note investing, which is a great business. And I've been involved in that for about 10 years or so. Additionally, we're also a private money lender. My roots are in lending. I got into mortgage lending in the mid 90s and have been a mortgage broker since 1998. So really enjoy that business as well. The distressed mortgage note investing is more opportunistic, and that business really thrives in when the economy is not doing as well and there's more distressed opportunities. You're starting to see some of that again now in this real estate cycle with the commercial office buildings. You're starting to see some of those buildings trade at really big discounts, 50 and 75% discounts I've seen on some of those towers that are trading. So the residential mortgage note business is similar to that. That business really thrives when the economy is not doing as well and when there's turbulence in the real estate market. It's typically a cyclical market every 10 years or so. You have some type of down cycle. The one we've been in right now, we're going on 15 years since the great mortgage meltdown of kind of '08, '09, that time frame. So at some point we're going to enter into another down cycle, and that's when that business really takes off. The private money lending business is great, and it really does well all the time, but volumes increase when people want to build more houses and refurbish and resell more houses. And so that's more of a stable business, I guess you could say.
So basically, you are waiting for the market to turn in order to resume the note investing.
Yeah. What tends to happen in that business is it's just yield driven. I mean, there was, loan portfolios that I was buying 10 years ago that were, let's say they were trading at 30, 40, 50 cents on the dollar. Well, as the economy recovers and housing prices are going up and people have capital and the economy is being stimulated, those same portfolios are trading in the 90s these days. So it really compresses the yields, and there's still money to invest in that, more institutional money, but it doesn't achieve the kind of yields that I'm interested in. So I still bid stuff. I still price loans out. I still have my finger on that marketplace, and I still buy a few loans here and there. But yeah, once the economy starts to slow down a little bit more and we see some more cracks, that's when that business really takes off.
So the main risk associating with mortgage note is that you actually acquire something that doesn't have a proper appealing yield. So give us a number, range, what you're looking for.
So on the distressed note investing business, total return looking for the mid-teens, typically.
In which markets do you think is most appealing to get that kind of yield?
Say that again.
Which markets, which areas in the US do you think you can get?
It's not really geographically centered as far as the yields go. It's really more of a macro picture of it. So when the economy is not doing well and you start having more distressed assets available and prices are going down and yields are going up, it's not so much centered on a certain geography necessarily. Mm-hmm. There might be pockets, but it's really a vast business. A lot of people don't realize the distressed debt business, but how big it is. I mean, the biggest of the biggest Wall Street firms, BlackRock and everybody else, they have huge distressed investment funds, billions and billions and billions of dollars. I mean, right now, from what I've read, there's well over $100 billion in dry powder sitting on the sidelines, just waiting for the commercial property reset to happen. And it's starting to happen a little bit. So
what's your competitive advantage?
When that starts to happen, the distressed investment business, you really have to pick where you want to invest. You think about anything that has debt associated with it. I mean, from obviously residential mortgages, but commercial mortgages, credit card debt, automobile debt. I mean, people finance airplanes, oil tankers. I mean, literally anything that has financing associated with it, there's a distressed debt market for that. There's somebody buying distressed oil tanker paper out there, right? Mm-hmm. So it's not so much geographically driven. There is a geographic component, especially from a legal and compliance standpoint. Some states are more onerous than others to do business in and things of that nature. But it's really picking what market, not geographically, but what product type you want to participate in. For me, it's mainly 1 to 4 residential. I personally kind of like the sub-performing and reperforming paper. Mm-hmm. You get better yields on that. And then I like to offset that with good equity positions. Mm-hmm. And we're also looking for, we have a buy and hold strategy. So mm-hmm. other people may buy and they have a multifaceted exit strategy. Some of them buy and they're There's a portion of it they resell immediately, and then part of it they think they're going to be taking the houses back, and then for some of those houses they'll fix and flip them. Other ones they'll put into a rental portfolio. We like to buy paper. Personally, I like to buy stuff that's going to perform and just pay over time, and we'll just hold it through duration. We have no intent of ever reselling it. That's kind of our personal strategy.
Sure. So what's your deal size?
It varies. We're a small to medium-sized fund, so we look at portfolios up to $10 million in size.
Okay, perfect. And so have you considered any other asset class? I know you say you're looking mostly at single families, and you just mentioned yachts and jets and anything that can be financed pretty much. So have you considered diversifying?
Well, there's a couple considerations there, Sendra. One is your area of expertise. Like, I've been in residential lending my whole life. That's all I've ever done. So I feel that I have some level of competency in that area. And to go out and invest in another asset class, even commercial, is enough of a different animal that I don't really feel I have the expertise to really compete at the highest level in that, and certainly not some of these other areas. So I'd have to really go out and learn a new skill set to switch into a completely different asset class. And then B is there's no public clearing market for these. It's not like there's an MLS for like there's for houses, or there's a stock exchange or something else. There's no public clearing entity. So this is really, I spent 5, 6, 7 years literally just going to conferences, making phone calls, making connections, networking, because you have to find out who owns these assets, who wants to buy them, who wants to sell them. And it takes a long time to not only find that network, become part of that network, but then to become a trading partner, because there's a lot of sensitive information. So you have counterparty risk. You want to make sure that the transactions are going to close. So even if you find the people who are selling these assets, you have to earn the right to do business, so to speak. And so it takes a while.
Well, thank you so much for that. So what is your due diligence? So when you talk about finding them, so you build a relationship, they trust you, they send you the deal. What's your process? What steps are necessary for you to actually execute and say, this is the one?
Yeah, great questions. So, it really starts out from just a data analytics standpoint. So you just get an Excel spreadsheet with numbers on it. And that has all the information you need to make an initial decision, from equity positions to the coupon on the loan, the interest rate, to different loan types, to the geographic location of the property. You really have the three. You have equity, income, and credit. That's really what you're analyzing in any type of residential loan scenario. You don't necessarily have access to all information. When you're buying a distressed or legacy portfolio, these are loans that have already been originated. And especially if, depending on how long ago they were originated and what the situation is with the loan, you don't have access to necessarily all the information. So we don't, if it was a loan that was originated 3, 4, 5, 6, 7, 10 years ago, we certainly don't have current credit and employment information, stuff like that on the borrower. So you're really just underwriting the performance of the loan to value when it was originated, what the asset is worth today. You're figuring out what your yields are based upon how you think those portfolios are going to perform. So you're looking at all that type of information. Once you make kind of your initial just data-based decisions, you can price that out. It's a competitive bidding situation most of the time. Sometimes it's just a one-on-one sale, but typically it's a competitive bidding situation. And then if you're awarded those loans or some portion of those loans, then you go into a much more deep dive on the due diligence. And it would almost be akin to underwriting a new origination loan. But first of all, we're going to verify everything that was on the data tape. So you're going to get the loan package. Sometimes you get a very thorough package from the origination package. Other times you're literally just getting a skinny file, and it might just have the loan collateral in it and almost nothing else. Sometimes you don't even get a full loan collateral file. Sometimes there's a lost note affidavit. Things get lost over the years. Stuff happens. So you're going to be doing a deep dive analysis on all that stuff. You're going to look at the property much deeper as far as valuation goes. You're going to look at the collateral to make sure that you have a legitimate lien, right? So you're going to look at the note and the deed or the mortgage, and you're going to look at a compliance perspective to see if there's any compliance issues. A lot of times, it's not like distressed notes trade just because of poor payment history. Matter of fact, a lot of times that's not the issue at all. Maybe, I don't know, 25% of loans on the discounted mortgage market trade because of payment history issue, maybe even less than that. If you look at kind of what's called the scratch and net market, which is stuff that's trading right after origination or shortly after origination because they found a flaw in the origination, and it's typically pretty minor, and those loans just can't be securitized, and so they go to the secondary market to be traded. They can have just a documentation issue. You can have, there's so many compliance guidelines in residential mortgage lending, especially owner occupied. The lender might have missed like a 3-day compliance window where something had to be signed by the end of 72 hours and they got it signed on the 4th day. Well, that loan can't be securitized, and it'll trade at a discount, but it'll trade at 99 or 98 cents on the dollar, not really a deep discount. So we're going to look at all that stuff. We're going to look at the compliance. We're going to look at the property value. We're going to look at, compare all the information that was on the data tape, make sure it's all accurate, and then come to a final decision, our final pricing, and then we're ready to transact.
That's fantastic. So do you do all this due diligence with in-house, or do you also outsource it to third parties, title companies, appraisers, et cetera? How many partners do you have?
We manage the process in-house, and we do some aspect of the review in-house. And yes, we use a lot of third-party companies for different aspects of the collateral review or the property valuation or things of that nature.
Wonderful. So tell me, so you have all these wonderful relationships. So they're primarily institutional investors or institutional structures that actually offer you these, or do you have individuals coming to you also saying, look, I have this, do you want to, acquire this?
So it's very interesting, Sendra. What I realized when I got into this business was there's literally the biggest Wall Street investors with multi-billion-dollar funds, all the way down to almost mom and pop investors, if you want to categorize it that way, family wealth offices, single high net worth or medium net worth individuals who view this as an investment strategy. It definitely is not mainstream, but it exists outside of institutional. And yeah, so I've done trades with literally individuals who own a portfolio of loans, and all the way up to there is a broker community for these asset classes, institutional and just single people who that's what they do for a living is they go out and they find these portfolios and they put together buyers and sellers. So there is a broker community out there, and there's large institutions. I mean, Wells Fargo has a big trade desk. There's lots of institutions that have trade desks for this paper. So it's really all the way up and down the scale.
So have you come across Larry Fink in your wheeling and dealing?
No.
He's one of my favorite people on the whole planet. Look at the smile. Anyway, so on that note, have you gone offshore for any of your transactions, or you just stay within the United States?
Stayed within the United States. I've looked at paper in Europe, looked at some of the American-owned,
like Virgin Islands and
places like that. And once again, it's just you're getting into a whole new world of compliance, legality, understanding, hey, how do you foreclose on a property in Scotland, right? I don't know, and I'd have to go find out before I could buy that portfolio. It's just a whole, and then if it was originated in another country, the documentation is going to be completely different, the legal structure, and then managing and servicing overseas is a whole nother ball game. Typically, the servicers that we would use here onshore, they would not be equipped to service offshore portfolios, and we don't really have a network of support people, lawyers and accountants and all that stuff. So it would be tough to do something like that, but we've looked at it before. Sendra, it's all about yield, really, at least for me. I mean, that's the bottom line is yield. And that's what I'm looking for is a good deal. So if you told me, like, what's your number one thing that you're looking for? I'm looking for a great deal.
Yeah.
And so if you bring me a great deal, I don't care where it is. If the deal's great enough, we're going to figure out a way to make it happen if we can.
So tell me about the time frame. So from the moment you have these great relationships, they make a call, they text you, they say, I've got this, you do your due diligence, you're like, I want this. From the time you make a decision and from the time they agree to, because you say there's a bidding process involved, tell me, what does the time frame from the time of decision, you execute, you buy,
it's pretty quick,
and you close?
It's pretty quick. Now, we're just assuming that everything else is in place. Let's say this is a counterparty we've done business with previously, all that stuff. We're awarded the loans. It's a 30 to 60 day process from the day they tell me, hey, we want you to buy these loans.
Mm-hmm.
And a lot of it has to do with the seller and the selling entity. We can move actually very quickly. It's kind of the same thing even in just a residential new origination. We're typically sitting around waiting for the seller to send us stuff. That's what takes the longest. So if you have a super motivated seller who's really on the ball and we send out, they say, hey, great, you're awarded these loans, and we send out our due diligence requirements, and they turn around and they get us stuff in 24 to 48 hours. And then as we discover things during due diligence, we need the next level of documentation or information, and they get that to us in another day or two. Yeah, we could complete a transaction in a few weeks. And we have, but that's not the norm. It usually takes longer.
So, Richard, what makes you so competitive? Because you are dealing with some major players out there. You said you're small to medium size. So what makes is it the relationship? Is it the time of execution? Or just because you're a nice guy? What is it about you that makes you get the deal?
It's interesting. Certainty of closing is a pretty big deal in this business. And also counterparty risk is a pretty big deal in this business. So those are important things. So if you have a good reputation, that you're a good counterparty to do business with, the information is locked down, you're going to be a good steward of those assets. I mean, these are a lot of people in their homes, right? So you're servicing these loans. So there's a lot of compliance. There's a lot of PR that can go into some big bank. The last thing you want to do is sell a portfolio of loans and then they aren't serviced properly. And certainly there's going to be blowback on the originating lender. They don't want that. So there's being a good counterparty is important. Certainty of closing is important. Obviously, things happen during the due diligence process where pricing changes or you have to remove loans from the portfolio. But knowing that when that doesn't happen, and then I think there's literally so many tiny little segments of this business. Like you mentioned geography. Well, you have loan amount, you have performance history, you have loan type. Is it a first mortgage? Is it a second mortgage? Is it a fixed rate mortgage? Is it an adjustable? Is it a reverse mortgage? I mean, literally, I could go on and on with the little silos and segments within distressed note investing. There's literally hundreds. And so it kind of, whatever your particular flavor is, you're probably going to be a little bit more competitive in that area because that's exactly what you want to buy. So when things come along that fit your silo, you're probably a little bit more competitive. And it's just timing too. Not everybody's bidding on everything all the time. So you might be the high bid 1 month and a month later you wouldn't have been, but some of the other players were busy doing other trades and transactions. And so it's just when things come along at the right time as well.
So you mentioned that your strategy is long term. So you're currently holding now?
We are, yeah.
So how big is your portfolio? Are you looking to add anytime soon?
We are, yeah. So we're constantly looking, and even through this whole market where the yields have been compressed, we've been pricing out loans, and not as many because it does take a fair amount of time and effort to price these loan portfolios out. And if you're rarely getting awarded loans, which is what's been the case the past 4, 5, 6 years, we've pivoted and we're spending a lot more time and energy on the hard money, private money origination business. Because we're in a better cycle for that right now.
Mm-hmm. Well, fantastic. So for new investors, someone who's actually already in finance, they want to get into note investing, do you have any tips for them? How to penetrate, probably if they don't have 7 years like you did, have to build your relationship. Let's say they only had like 7 months.
Yeah, I think what's the better? You probably have to piggyback and know somebody like me or somebody else like me, or find people who are brokering these transactions and build a relationship with those people.
Do they have to be licensed for these type of transactions?
Licensing varies state to state, and depending upon, there's a lot of different components. There's acquiring, there's holding, there's servicing. Different entities require different licensing. So we use third-party servicing, which is required to be licensed. There's pretty strict licensing for servicing.
Mm-hmm.
But typically, for most places, for just a private individual to buy and own a mortgage note, they don't need to be licensed.
Okay. So if somebody brings you a deal, they don't have to be licensed.
No.
Okay, perfect. So this has been fantastic for this segment on note investing. And of course, you are all things note investing. That's what I thought about my audience. What could they learn from you? So I hope you got some wisdom. And of course, Richard, can you please share your information? How can they contact you if they want to?
Sure. Easiest way is just to send me an email. And that's my name, R as in Richard, last name Mason, Mason, at northernstarmortgage.com.
All right. Thank you. And
then go to our website,
which is
northernstarmortgage.com as well.
All right. We will put all that information for you at the bottom of the video and the podcast. If you have any questions, suggestions, please comment as you always do. Thank you so much. I so appreciate you. Once again, I look forward to seeing you next time.
Thanks, Sendra.
Thank you, Richard. Hope to see you again soon.
Subscribe to Frankly Speaking with Sendra D and join us each week as we uncover stories of resilience, transformation, and the pursuit of your true affluence mindset.
And I won't sit down, won't back out. You can't ever shut me up.
Come and join me on this journey. I promise not to disappoint. Don't forget to make sure you like, subscribe, and share to be notified when a new episode is released.